Hello guys, welcome to the 24th of March session. Let's have some, wait, 1 second. Now, let's have some fun with finance, alright? Okay, let's go. Yes, let me go back. Okay, so how are you guys? I hope you're doing okay. We are in our third week of quarantine, and it's only gonna be at least two more for us. Actually, this week we start with a total lockdown. Okay, so every worker that is not essential has to stay home. And if you can't work your house, then there is a new thing here in Spain. They just created. It's like you are allowed to stay home. You get paid, and you will recover the hours once you can go back. It's a new measure. Okay, so have people stay home these days. All right. Um, so yeah, that's gonna happen, and but also we are making our mind okay that probably kids won't go back to school if we are really lucky, not before June. So yeah, I mean that's what's going on around here. I hope you guys are doing well as well. Okay, all right. So let's start with this session of finance. So what we're gonna do today? All right. So finally, we are done with this. Okay. I mean, you think about it. This is one of our two last lessons. Okay. We're gonna today we're gonna end up the rest of the chapter, and then this week we're gonna have one more lesson, the one that belongs to the 26th of March. There we're going to talk about chapter 5. We're going to talk about futures and options. You know how we have been talking a lot about them. Okay, so it's time to give you some information about them. We won't have time to go too deep into them. Okay, but still some information is going to be interesting. So whenever you go ahead and keep going in finance, you will be able to catch up with the things that we're going to talk about. Okay. And that's it. Okay. After that, then we will have 2 days where it was supposed to be the day before Easter. Okay. This week when I'm recording this video, where that was the days for the presentations. Okay. I told you, remember that we have pushed that back after Easter. Okay. So and you watching the videos other people are doing, it's gonna be like these 2 days, okay, and commenting on completing the feedback that I'm gonna ask you to complete for the rest of the class. That's gonna be like these two classes. That's how we're gonna recover also the time that we suspend the classes. And then after Easter I will record one more final review, and then we will have the SAM. Okay, in the SAM, as I told you, it's gonna be a little bit different. Okay, it's still I'm going to ask you to do some problems, okay? Like I think even this is an open book. Well, the problems can be something interesting to do in exam, and then you will have to a question, okay, related to the stuff that we have seen in class, okay, that you are going to be able to research about it. All right, so it's going to be like an open book kind of problem. So we will eliminate the multiple choice because they don't make that much sense at this point. Okay, we will change that part for a question, like a research question. Okay, that you have to research about. Okay, so today we're gonna, as I told you, we're gonna start with these three parts of the chapter that we're missing. You know, we have been basically all the time after the midterm, once we completed the chapter 2 that we had from the first part of the semester, we have been talking about the interest rate parity because that's the theory that is really useful in the world of finance. It's the one that we can consider an arbitrage condition, okay, like an equilibrium condition for arbitrage. Okay, it's the one that is truly interesting when it comes to try to predict the value of currencies or the value of interest rates, okay, in the future. Purchasing power parity or future effects are not that useful. Okay, that doesn't mean that they are not useful at all. They are. They're gonna give us some information, But especially when it comes to purchasing power parity, the one that we're going to talk about today the most, you're going to see how they are not as reliable as the interest rate parity is. Okay, it's interesting, it's going to give us some information, but not the kind of information that can allow us to, for example, perform an arbitrage. Okay, and then when it comes to forecasting exchange rates, I just want you guys to know some of these techniques. I wanted you guys to have a glance of how crazy this world can get, the world of finance. Okay, just in case whenever you go to you go on finance, you go on finance. I remember when I was a student, I had a class just for that part, just for to learn some of the techniques that I'm gonna talk about to you guys today. All right, so that's what we're gonna be doing today. All right, so let's move. All of this we have done it, rate parity. So we're gonna talk about the purchasing power parity. Okay, we're gonna say what it is. We're gonna try to find real evidence in the real world about what it is. We're gonna do a couple of problems to train with the application of the formula, and also we're gonna talk about the reason why we say that, well, it's not as reliable as the interest rate parity. Okay. Then Fisher effects, we're gonna kind of jump it around, and then we will talk about the different techniques to forecast exchange rates, and with a special speech about the technical approach. Okay, it's the one that I find most interesting. Is the one that is more fun probably, and also the one that I used the most when I invested a while ago in the past. Okay. All right, so let's start talking about the purchasing power parity. Okay, so as I told you, purchasing power parity, let's see what it is. Let's obtain the formula the same way that we did it with the interest rate parity to see how we can use it. Then, after doing some problems, we're gonna see the little reason why we can totally trust it as investors, okay? And then we're gonna try to find some evidence on the purchasing power parity, okay? Also here I will give you an update. Maybe when it comes to the evidence, maybe some of you guys have heard about the Big Mac theory. Well, this is the one that we call the Big Mac theory, the purchasing power parity, okay? Because there was a kind of important study a while ago, okay, that tried to prove the theory through the analysis of Big Macs from McDonald's. Okay, it kind of became famous. Well, even that have changed a little bit. I found an interesting article the other day about that. Okay, so I will share with you guys later. Right? Okay, so the purchasing power parity. Okay, we can talk about it using two different versions. The absolute version, that it will be going product to product, okay, one product at a time, or the relative version, that it will be comparing several products at a time, and to do that we're going to use inflation rate. But let's start explaining the basic idea of what it is, okay, through the absolute version. Okay, it's quite simple. All right, it says the theory that the exchange rate between two currencies should equal the ratio of the country's price levels. One product should have one price. Take this marker. Okay, you can see it. It's a big marker for whiteboard marker. Okay, I'm pretty sure that you have this exact same marker in the States. Okay, with the exact same brand, exact same color, everything. Okay, so what this theory says is that if this market is gonna cost us, say in Spain, for example, €1. Right here, €1. Okay, and in the US, this same market costs $1.5. Okay, since the product is the same, the reason to explain why these two numbers are different should be explained through the exchange rate. Okay, so the exchange rate between dollars and euros, looking to this marker, should be $1.5 per €1. Right? As simple as that, right? If we have the same product, they should have the same price. If the price is different, that difference in the nominal price, in the tag price, should be explained through the exchange rate. That's the idea, the general idea of the purchasing power parity. Okay, the absolute version. Of course, it's really easy to see a sample where this won't really count. Okay, for example, you can do the exercise to go to Apple, apple.com, and then you can go to apple.es, the one from Spain. Okay, in the Apple Store in the US, the Apple Store in Spain, you're gonna see the same products, and most likely, most of the products are gonna have the same nominal price. So imagine, no, if one MacBook Air 11 inches costs $999, in Spain it's gonna cost 999 euros. Okay, and it is true that right now the exchange rates are close to parity. Okay, but the situation was even like that when the exchange rate between dollars and euros was $1.6 to euros. The nominal price was the same. So that's why, for example, when the time that I went to the States in 06, those years, 06, 07, okay, if you wanted to buy something from Apple, something kind of big, okay, like an iPod back then, okay, it was wiser to have a friend that was going to the States to buy it for you, okay, because basically it was half price for us, okay, you buy in the States the same product, right? So of course there are other reasons, that there are other elements that are going to influence exchange rates. We can expect exchange rates to be influenced just for the difference in prices. Okay, I mean, we have learned many different reasons that are going to influence exchange rate here in this class. Okay, I told you even that there are some that we can even control, since it's interest rate, just by looking at interest rate parity. But remember, speculation, okay, changes in demand, changes in the offer, the impact of different phenomena, okay, even this situation right now, the coronavirus and everything is affecting exchange rate. So just prices is a little bit crazy, okay, but still I promise you're gonna give us some information, so stay with me on this. Okay, so one more example on this. Okay, using gold. Gold is gold everywhere. Okay, anywhere where you are is always gold. Okay, so if an ounce of gold costs you $300 in the US, 150 pounds in the UK, okay, then that means that the exchange rate between the dollars and the pound should be $2 per WAPA. So as I told you, the absolute version of the purchasing power parity goes 1-to-1. Okay, one product, one price. Simple, right? Let's go ahead and check out the relative version. Right? So the relative version, okay, let's imagine this. No, suppose that the chain rate, the spot chain rate, is $125 per euros. Okay, so let's sample. Actually, close to what we have right now. If the inflation rate, just a little break here, I guess you are familiar with this, okay, but this pi is how we talk about inflation in economy, okay, not just in finance, in economy. All right, so if I ask you a question about this or whatever, and you write this being 3.14 exceeded in finance, someone say that it was 3.14, 15, whatever, okay, I mean, yeah, I may have to do. I don't want to say that I want to kill you because this is recording, okay? But yeah, I mean, that's bad, okay? So don't do that. So the inflation rate, okay? The inflation rate is basically how we use it. So say if in the US it's expected to be 3% for the next year, in the Eurozone it's expected to be 5% for the next year. These inflation rates, okay, should help us to predict how much the forward rate is going to be for the next year. Okay, because in the relative version of the purchasing power parity, we're going to use inflation rate to understand how prices are going to evolve. Okay, how? Quite simple. All right. The forward rate will be the spot rate. Remember, 125 over 1 euro. Okay. The dollar is going to change by the inflation rate in dollars. The euro is going to change by the inflation rate in euros. Okay. So we multiply this. We do some math to keep it in a 1 euro base, and it's gonna give us 1.23 over 1 euro. Simple. Okay. So we are saying that in this case we're gonna need less dollars to buy 1 euro, so the dollar is gonna be appreciating. Okay, it's trading at a premium, the euro is trading at a discount. All right, but still hard to see what is the use of this. Okay, so let's work on the formula. Okay, let's work on a formula that can give us some information or that can help us to know what we can do with this theory. Okay, so for the formula, let's play a little bit. All right, let's play a little bit with what we have. We have the forward rate. I told you, okay, 125. Let's use the same numbers that we used before, okay? And let's play by starting by dividing by the spot. Let's play, just for fun, okay? So I divide by the spot. I'm gonna write the same thing here, all right? Now you realize, basic math, okay? This number is the same as this one. This here is not this one. So basically, they are going to cancel out each other, right? Basic math, okay? So all that is left is going to be this. Or in other words, this. 1 plus the inflation rate, 1 plus the inflation rate, okay? So we can clean this up a little bit. And also let me clean this up here. And we can say that this is going to be the formal version of the purchasing power parity. The formal version of the purchasing power parity. Okay? The formal formula over here. If you remember, this expression should be somehow familiar to you guys. It should ring a bell. Okay? If you remember, this expression is quite familiar or quite similar to the formal formula, the formal expression of the interest rate parity. It was basically the same, but using interest rate instead of inflation rate. Let's move to the slide, okay, and you will remember, okay? That's basically the same idea. The forward over spot, it's the same, okay? And then here we use interest rates, and here we use inflation rates. So they are really similar to each other, okay? The same things that apply to the interest rate parity apply to the purchasing power parity, okay? The order matters, so the order goes connected to the order of the change rate. So you have dollar to euros, that would be dollars and euros, okay? The order is the same that we have for the interest rate parity. So the same way that we had, remember, an informal version of the interest rate parity, the one that we use for the problems, we can also develop an informal version of the purchasing power parity. Okay, you're doing the same math, the same approximation. Okay, I'm gonna have a very similar expression with, on one side we're gonna have the forward premium, and on the other side we're gonna have the, in this case, the inflation rate differential. Okay, to summarize all the things that we can do with the expression, I did this this slide to show you all that you can do, right? So on one side we have the interest rate parity, the exact formula, okay, and the purchasing power parity over here. Then from this we can infer the approximation, the informal version of the interest rate parity. The same way that we did that, okay, we have the exact formula for the purchasing power parity, so we can extract the informal version for the purchasing power parity. And then you realize the forward premium is the same. So if they are the same, and that's why this arrow, what this arrow means, okay, that means that the interest rate differential and the inflation rate differential should be around the same. Okay, at least information that we can extract just from pure math. Okay, later it's time for us to see if this has some sort of real application, but from math, that's all the information that we can get. Okay, that we can come to the informal version of the purchasing power parity, that we can come to the informal version of the interest rate parity, and that we can do this kind of shortcut, okay, to compare inflation rate differential and interest rate differential. That's us playing with numbers, with symbols, with formulas. Okay, now let's see if this has a real application or not. What is the real application of this? Well, let's clean this up a little bit. All right, magic happens. What is the real application? Let's say, for example, that the forward rate is bigger than the spot rate. What's going on here? We are expecting the forward to be bigger, okay? So that means that we are going to need more dollars to buy 1 euro, okay? So the dollar is trading at a discount, the euro is trading at a premium. The euro is getting stronger, the dollar is getting weaker. We're going to need more dollars to buy 1 euro. If that is true, then from the interest rate parity, we can expect the interest rate in dollars to be bigger than the interest rate in euros. Remember, since the dollar is losing power, losing value, to attract investors, we need to increase the interest rate. We say that, and that makes sense, okay? But now, to understand why that's happening, maybe one reason why that's happening, why the dollar is losing value, it can be explained through the purchasing power parity. If this is true, then this has to be true. The inflation rate in the US is bigger than the inflation rate in Europe. So that's why inflation rate is bigger, means that $1 tomorrow will be worth less than 1 euro tomorrow, because the inflation rate is bigger. So it's losing value. That's why the forward, you're gonna need more dollars to buy 1 euro, and that's why you need to increase the interest rate. So everything makes sense, okay? If the forward, for example, other example, if the forward is lower than the spot, like this, okay, means that we are going to need less dollars to buy 1 euro. Now is the dollar the one trading at a premium. Now is the euro trading at a discount. Okay, now is the euro the one losing value, while the dollar is the one that is making is getting stronger. Okay, well, if that is true, then from the interest rate parity, we can say that the interest rate in Europe now is the one that needs to get bigger, because they need to attract investors, because the euro is losing value, and a reason to explain why is that is happening should be explained, can be explained through the inflation rate. The inflation rate in Europe now is bigger than the inflation rate in the US. Okay, so it makes perfect sense. Okay, so this purchasing power parity, even though we can use it as a certain way to predict how the exchange rates are going to be in the future, it can help us to understand the reason why the exchange rates and interest rates are changing in a country. Okay, that is true. Okay, but there is more. Okay, there is more. We can say it also can give us information about a really classic basic trade-off that we have in the world of economy, something that you learn in economy 101. Okay, so we can say if the inflation rate, for example, is bigger in Europe, from the purchasing power parity, we can assume that the euro is going to be depreciating, like we say here, okay, because the euro is going to be losing value. From the interest rate parity, we can assume then that the euro depreciating, that the interest rates in euros need to get bigger. We knew that already, okay, from the purchasing power parity. And from this shortcut, okay, from this here, that's what I was telling you, okay, we learned about this classic 101 economy trade-off, okay, between interest rates and inflation rates. Okay, it's a classic trade-off in economy that we say whenever the economy is doing well, okay, and people are having jobs and they are buying stuff, okay, prices are going to raise. Okay, once the prices are really high, we need to somehow to contract, to stop the economy a little bit, to relax the prices. How are we going to do that? We are going to start increasing interest rates. Here, we're going to start increasing interest rates. Okay, so the economy stops because people won't have that much money to spend. They will prefer to save money in a bank rather than to spend it. So people are gonna start, companies are gonna start spending less money. Maybe some people will get fired, etc. Okay, so that we have less money and we can relax the prices. People won't be buying that much stuff. Once the prices are really low and the interest rate really high, we can start doing the opposite. Okay, we can start relaxing the interest rates, so we reactivate the economy, and prices start to raise up again. So it's a classic trade-off. Okay, if one goes up, the other goes down, and vice versa. Okay, it's the same idea that we discussed with unemployment and interest rate. It's the exact same idea. Okay, it's another part of this classic trade-off. Okay, between unemployment and interest rate, between inflation rates and unemployment, inflation rates and interest rates. All of that is all together. Okay, so from this shortcut, from this purchasing power parity, from this combining of the purchasing power parity and the interest rate parity, we can see that actually, well, makes sense. Okay, so that makes perfect sense. Okay, all right. So now I'm gonna ask you to pause the video. Okay, to pause the video for a while. Okay, I want you guys to work on these two exercises. Okay, both of them can be found in the book. Okay, remember also you have the book part of what we are talking about in the canvas on the models. Okay, under the chapter 4 section you will see also the book. Okay, even though I'm not linking that to the online classes. Okay, but yes, you also have the book there. So in the book you can extract these two problems. Okay, so let's pause for a second and you guys try to do the problems and then you come back. Okay, of course, if you have any questions, okay, I open a class discussion. I will tell you at the end of the video. Okay, I open a class discussion for comments on this session. Okay, for doubts, I ask you a couple of questions about something that we're gonna see later. Okay, but you have any questions also about the problems, also you can go to the discussion panel to ask about it. Okay, all right, so let's pause the video and let's try the problems. Right, welcome back. Do you want to see something cute, a slide kind of sad? Okay, it was the suitcase that for my daughter that we were supposed to be traveling this Saturday, this weekend, to Sevilla, to my town, to stay a week with my parents, okay, grandparents for my daughter. She was really excited. It's already packed since a month ago. So yeah, I mean, but well, I mean, she doesn't really get the conception of time yet, so I'm using that. Okay, for her, the past is yesterday. The future is tomorrow, so I'm playing with that. Okay, so yeah. Okay, so how was the problem? Okay, let's check them out. Okay, first this problem, problem number 5. Really, here we can't tell a number. Okay, so the answer for the problem is not really a number. All right, it's not we can predict the exact forward rate in the future because, well, we don't know the spot rate. Okay, but we can give information. We can give information. What kind of information? Well, if this is true, if the interest rate in the US is 5.93 and the interest rate in Turkey is 70%, okay, from the shortcut, we if that is true, that means that the inflation rate in the US, and that's probably the reason why that is true, has to be higher than the inflation rate in dollars. From the interest rate parity, we say if that is true, if the interest rate in Turkey is bigger than the interest rate in dollars, then we can predict that we don't know exactly how much is going to be the forward rate because we don't know the current spot rate, but we can predict a depreciation of the Turkish lira of approximately 64.07, the difference between these two numbers. We can predict that, okay, because the forward premium, remember, the forward premium express how much one currency is going to depreciate against the other in 1 year. If you remember the classic formula, the approximated formula, sorry, of the purchasing power parity or the interest rate parity. Okay, we say the forward premium equals to the differential of the interest rate or the differential of the inflation rate. If the differential of the inflation rate interest rate is 64.07, then the forward premium, the result had to be around 64.07, meaning a depreciation for the Turkish lira. All right, so that's all that we can say about this problem, but it's a lot of information, okay? And that's probably how we're gonna use the purchasing power parity most of the time, okay? So here you have the formula how you should look at this, okay? So if this is true, then we say that this should be equal to this, okay? So for the second problem, now we can give an answer. Okay, now yes, now we can give an answer because we have all the data that we need to obtain a number. Okay, so we have the 2.6% inflation rate in the US, we have the 20% inflation rate in Brazil, we have the spot rate being 1.95 reales to Brazilian real to $2. Okay, so that's the expression that we need to use. We can use the formal version, okay, but it's easier to use the informal one, okay. Anyway, this number is going to be an approximation. So we have all the information, okay. We have the spot, we have the inflation rate in Brazil and the US, and then we have the forward, okay. Be careful here with the order, okay. For this to obtain the number that you need, okay, you need to respect the order, okay. Remember, the order comes explained through the change rates. So we have reales $2, that should be Brazil $2. Okay, we need to respect the order. Okay, we need to follow the exact order. All right. So how we do this? Well, 20 minus 2.6, maybe over 100 times 185 plus 195, and we'll get the forward rate of 2.29. 2.29. Okay, and that's the forward rate that we have. So that's what we expect is going to be the forward rate in 1 year just by looking into these inflation rates. Okay, it's an approximation. It's an approximation. Okay, it's going to be hard to say that we can make an arbitrage based on this. Okay, even though also this is really close to the inflation rate, but still, it's an approximation. Okay, it's useful, and as I told you before, it gives us some interesting information that we can use. Okay, so those are the two problems. All right. If you have any doubts, remember you can go to the discussion panel and ask questions about it. Okay. Okay, let's continue. So, why do we say that in real life? Well, it's hard to trust it. It's hard to say that the reason why this has a different tag price in the US and Europe is only explained through the chain rate. There are many examples, many situations. I told you already the one from Apple, okay, the computers, the exact same product with the exact same brand, the exact same marketing, the exact everything, and the price is going to be the same, but the chain rate is not. Okay, so there are other factors that are going to influence the price. There are other factors that are going to influence the chain rate, of course. Okay, but here, you know, there are some attempts to try to prove this right. Okay, and some example of why, well, they don't really apply. Okay, so for example, this formula, this idea, we talk about products, but we hardly can talk about services. Okay, I mean, take a haircut. Okay, I mean, if you are not doing anything fancy, okay, take that you are, you know, like totally cutting all your hair. Okay, so that's kind of simple. Okay, plain and simple, all your hair goes away. Okay, if you do that in New York, in the Fifth Avenue, it's gonna cost you, I don't know how much, okay? But if you do it in a random neighborhood in the middle of nowhere in the Gambia, in Africa, well, definitely gonna cost you way less money, okay? I don't know, you use haircuts in Spain when you were here in Barcelona, but think about how much you paid. Okay, I mean, when I go to come here, I pay like around, I don't know. It's been a while. I don't come here that much, just a couple of times a year. So I don't know, around 15, 12 euros, I think. Um, and I know that for boys maybe it's a little more, but especially the difference I think is for girls. Okay, what you may be, for what I know, what I always ask in this class, okay, will be around 100 or 60 or $80 in the US. Here can be 40 or 50. It's a big difference. Okay, it can be a big difference. It depends on what you do and where you do it. Of course, it depends of where you can do her. Also here in Barcelona, it's not the same Paseo de Gracia than a random neighborhood. Okay, in the suburbs. Film, film, one of the highest standardized commodities. You're gonna see differences. Now we're gonna actually show you evidence. Okay, shipping costs, well as tariff, quotas, difference in the interest rates, more than interest rates, sorry, different in taxes. Okay, all of that is going to influence the value of things. Okay, not just the exchange rate. Okay, so here in the next slide we have some examples, some different analyses, okay, trying to find out that if this is true or not. Okay, first one, you have the fast food, the one that give a name to this, okay, the famous Big Mac study. Okay, so it was a research study that they went around the world, okay, and they check, okay, the different prices on Big Macs all around the world, being the Big Mac about the same. Okay, so, for example, if in Spain was, I mean, that was in pesetas, but let's say in euros. If it was 5 euros, and in France was, or in England was £4, then they translate that to dollars. And if the purchasing power parity is holding, once you translate it to dollars, all the prices in dollars should be the same because the products were the same. And the difference of the nominal price in different countries should be explained through the exchange rate. Okay, and you can see they are not the same. Okay, they go from the 450 here in Copenhagen or LA 453. Okay, right now it's higher. Okay, that was the study is kind of old. Okay, to the 186 in Rio de Janeiro, that probably is also way higher because Rio de Janeiro has become a really spent. Not all Rio de Janeiro, but some areas of Rio de Janeiro have become really expensive. Okay, so that's probably way higher. But you see how there is a difference. Okay, there's a difference. Also, understand that the Big Mac, even though it looks the same, probably not the same. Okay, different sizes. Okay, I guess you went to a McDonald's here in Spain and you saw how they sell stuff that probably they don't sell in the US. Beer, for example. Okay, that you won't see in the US, so everything is different even if it looks the same. Take drugs, legal drugs, okay, like in this case aspirins, okay, how huge of a difference it is here. Also drugs we take into a complicated world, okay, where in different countries drugs are gonna have a really different price. Okay, I don't know if you remember when we were talking about the financial crisis of 07-08, I told you about a friend I had, okay, that had leukemia, that bought a house, okay, and he thought that he was cheating the bank, or because they give him the mortgage when he knew that he was going to die sooner than later. Okay, what sadly happens. Okay, but while he was alive, okay, he has leukemia, the blood cancer, under control. Okay, but he had to take a medicine, okay, every day. So I remember that medicine, it was made by Novartis. Novartis is one huge pharmaceutical, okay. Novartis, and he paid. I remember because I went to buy it for him several times. Okay, he pays 10 euros. 10 euros for the month treatment. Okay, so for the box with the pills for the whole month. Okay, so 30 pills. He paid 10 euros. Okay, at the same time, in that period, okay, I had a American girlfriend, okay, and one relative of her, she also had the same problem, the blood cancer, leukemia, okay, and she was suffering a lot to receive treatment, and at the end also actually she couldn't get it, okay, because she didn't have an insurance, and that same pill, the same one that was taking here my friend, she was paying $1,000 per pill, not per treatment. So that would be like $3,000 per month. So huge, strongly difference, okay, that we can even compare, okay, here. And also a problem that, well, we are seeing right now happening in this whole global pandemic, how it's going to affect us. Novartis, by the way, for example, he had a huge case against the Indian government, okay, because you know about India has become like the one of the generic main producers of drugs, especially for Asia and Africa, and they have a huge claim against the Indian government because they were producing generic drugs that in other parts of the world they had the copyright of Novartis. Well, they lost. Okay, they lost. The Indian government won. Okay, that case. It was huge. Okay, and now India has become this huge producer of generic drugs. Okay, men's haircut. You can see here the differences are amazing. Okay, I mean, so you can tell. And then camera film. I don't know. Have you ever used a camera film to take pictures? Okay, I mean, you are all children of the digital world. Okay, but maybe you have seen one, I guess. Maybe you have used one. I mean, I always like to ask about this question. I mean, just think about the last weekend that you traveled while you were in Barcelona. Just think about how many pictures you took. A number. More than 20, more than 50, more than 100, okay? Or how many pictures you took while you were here in Barcelona? Thousands, maybe, okay? But now imagine that every 24 of them, you had to pay around 10 euros and wait for a week to see them, actually see them, okay? Well, that's the reason why from my childhood, I think I have like 3 or 4 pictures, okay, but no more, okay? It was for special moments only, okay? So it was a different world indeed, okay? Well, that camera film, that is a really standardized product, and the same product was used all over the world, okay? Kodak was the main producer of that, okay? That's why Kodak was really rich back then, okay? But even here, we can't see that there is an equality in the price, okay? By the way, once we enter in the digital world, okay, Kodak struggle a lot, okay? They tried to jump into doing digital cameras, but they weren't good doing digital cameras. They were good doing the film, okay? So they should have jumped to another chemistry fields, okay? They didn't see that. They didn't see that that was their strength, and they suffer a lot, and they were to bankruptcy. It was kind of sad to see them. Okay, that's something that probably if you are taking a strategy management class, it's a case that you probably are going to discuss. Okay, or I used to do it when I teach that class. Okay, so no strong evidence, no real evidence. Okay, but still, as you can see, you saw. Okay, it can give us some good information. Okay, some good information that we can use indeed. Okay. All right. Do you know, I guess, from IKEA, this bookcase, okay, this white bookcase is called the Billy bookcase, okay? So I found this article, it's kind of interesting. Like, instead of the Big Mac, theory, now some people call it the IKEA Billy theory, okay? Because there was a research study that tried to do the same thing that they did with the Big Mac, with the Billy's bookcase from IKEA, okay? Because apparently everyone seems to have one, okay? They have taken over the world, okay? And now you can see, for example, in Spain, I know it happened in the US, no, but a lot of TV shows and whatever, they are recording stuff from their houses. Everyone seems to have a Billy IKEA bookcase with them, okay? So I'm leaving you here this article. I think it's a fun read, okay? So I'm gonna give you a couple of minutes to read the article, and then you can go back here, all right? So please go ahead and read that article about Billy's IKEA bookcase. Interesting, right? So you know you can in the discussion panel that I open in Canvas, I ask you, you have a Billy bookcase? I don't actually right now. Okay, I used to have one, but when we moved, it was kind of old, and we don't have one. Okay, so I guess I one of the few in the resistance now. Okay, so yeah. Okay, let's move on. This is another numbers, okay, to try to explain the purchasing power parity. All the information you can read about this in the book article, okay, you want that you have in Canvas. Let's go to talk a little bit about the Fisher effects, okay. Well, these are basically all the different relationships that you can have when it comes to exchange rate, interest rate, inflation rates. We're going to talk about also you can talk about the expected real interest rate, so the interest rate without the effect of inflation. So these are all different kinds of relationships that we can have, okay. The problem is that for some of them, like happens with the Fisher effects, okay, is that we need some background in finance, and I know that some of you guys don't have it, okay, and they are kind of complicated because the Fisher effect, for example, they're gonna tell us the exact opposite thing of what we have been saying all along, okay. For example, we have been saying that whenever the exchange rate is your currency losing value, you need to increase interest rate, and the Fisher effect is saying, well, yeah, that's true, but if you increase interest rates in the short term, that's going to also increase the value of your currency, because you're going to attract customers in the short term, and they are going to increase the demand over your currency, so they're going to increase the value of your currency. So then you have to combine the short-term effect explained by the Fisher effect with the medium long-term effect explained by the interest rate parity. So it's kind of confusing, okay, and you need to throw our ground, okay. So I'm just gonna leave here this information, okay. Also you can see this slide, okay. You can see that in the book, you want to know more about it, okay, but I won't cover it for our class, okay. I wouldn't cover it if we were together in Spain right now on Canvas. But that's it, okay. We don't have to, you don't have to know anything about it, okay. I won't ask you to research anything about the Fisher effect, okay. All right, so let's move on, and let's go, once we pass all these slides, okay, let's move on and let's talk about how to forecast the exchange rate. All right, basically here I want to discuss these three approaches to forecast exchange rate. Really, it's not to forecast exchange rate, it's just forecasting techniques, okay, that can be applied to any kind of investment, any kind of financial product, okay. For example, technical approach, if I use it to invest on stocks, okay, no, not to invest on currency. All right, so I'm going to talk about these three approaches, okay, and then a few words about the real performance or the reality behind this performance, okay. Let's go from the beginning, okay, saying that none of them actually works. Okay, I mean, if it was easy to predict what's going on in the future, okay, no one will make a profit, because everyone will be investing on the same direction, so no one will have a profit. All right, but still, if we are investing company, we need to sell a bias, okay, so we can say that we are selling something that is rubbish, okay. So let's see how that works. First, we have the efficient market approach, okay. This is not really a technique, okay, this is just assuming reality, okay. The efficient market approach say that financial markets are efficient, okay, so all available and relevant information is already reflected in the price, okay. If a company is doing good, if a company is doing bad, if a company is doing a new project, whatever, as soon as the information is public, and sometimes even before, okay, if we take into consideration insights trading, but as soon as the information is public, it's going to be reflected the second after in the stock market, because people are going to start to invest as a consequence of that information. So assuming that, you say that exchange rates only exchange rates or stock prices or the financial product price only change when new information arrives. So basically that means that the best predictor for tomorrow's exchange rate or tomorrow price will be today's price. What does it mean? That there is no point to do anything weird, okay? That there is no point to do anything fancy. If you want to invest, just check out how the prices are going today, what is the evolution of the prices today, and then invest. Okay, so basically it's saying that being random, doing node analysis, is your best option, is your best chance, is your best shot. You know what happened? That real data, okay, don't prove this approach wrong. Okay, this the fact that being random is your best shot is really hard to attack, because data show us that as an evidence, okay, that is kind of right. Okay, you know, there is kind of a legend in the world of finance. It's half legend, half reality. Okay, you know, you're gonna see where the legend kicks in. Okay, but there is a part that is a reality. Okay, in the 80s. No, it was more the 90s, okay? The Financial Times, okay, decided to organize investing challenge. Okay, investing challenge, inviting investing companies to prove their techniques, okay, to see which one was the best, okay? So they compete against each other, okay? And then the Financial Times was going to be doing random investments to compete against them, okay? That's the reality. The legends say that to do random investments, they had a monkey, a real one, okay, not like Miko here, okay. So they had a monkey throwing darts against an ice ball thingy, okay, on a paper with all the investments, okay, and the monkey was throwing darts, and then how they choose the random investments. I don't know if you saw the Wolf of Wall Street, but after watching the Wolf of Wall Street, I thought, well, maybe that wasn't a legend, not totally. I mean, they had a monkey at some point, okay. But well, the thing is that for many years, when they did this, okay, the randomness won to all the investing companies, okay. Actually, I did that in class when I was started teaching, okay, for a couple of semesters, okay. We did that kind of deal, okay, with this website that allow you to do these competitions, okay, for free and whatever. Out of the 4 or 5 times that I did it, like 75% of them I won. Me being the monkey, being random. Okay, so yeah, randomness is really hard to beat. Okay, but the thing is that you can't sell randomness. Remember what I told you before. At the end of the day, you are trying to sell stuff. Okay, so you can't sell that you're gonna be random to your client. Okay, so for that we have the fundamental approach. The fundamental approach is the one that you truly can sell. Okay? The fundamental approach basically means that you are going to analyze everything about the financial product that you want to buy or sell. Everything. If it's a company, for example, you're thinking about investing in the company, you're going to send in people to research about the company. You're going to study everything about the company. They're going to see how they work. Okay? They're going to see their strategy, their numbers, their plans, okay, their building, everything. And then they are going to develop a model, okay, and they're gonna do this whole report on the company, okay, with a lot of formulas, a lot of expressions, okay. And at the end, in the report, they're gonna have a square saying buy yes at 32, sell at 45, and that's all what you want, okay. So when you're a client, you're receiving a lot of information with all of the formulas explaining things. They won't explain you how they do the formula, of course, but you see a lot of numbers, okay, and then with the buy at 32, sell 45. So you have the impression that they have worked for you, and you can pay for that. That you can sell it. Tiny issue, tiny problem, that there are no proof that this is any better of being random, right? So that's the reality, as I told you. But that you can sell it. So most investing companies that sell advice use this kind of approach, fundamental approach. Then we have the one that we call the technical approach. This is the more fun, also the most crazy. Okay, let me tell you. This is why the fundamental approach is used for investing companies to, especially investments in medium, long term. The technical approach is mostly used by brokers, so people that actually invest, okay, and for short-term reasons, for short-term investment. I use it for that, okay, to decide in intraday operations, okay, where to buy, where to get in, where to get out, okay, where to get in, where to get out. So what it says, technical approach based on the idea that the past is going to repeat itself. Okay, the prices follow historical patterns, and what they have done in the past, they're gonna do it again in the present. Okay, the history is going to repeat itself, like if prices were alive, regardless of real life. We're talking about the evolution of prices. Okay, that sounds crazy. It is crazy. Okay, to think that prices are alive and they're gonna move in a certain way or whatever. Okay, but that is what we call the Pygmalion effect. Okay, and that's the cool thing about this technical approach. If enough people believe that something is gonna happen, at the end it's gonna happen. That's what we call also the self-fulfilling expectation theory. And this technical approach is basically based on the idea that enough people are going to believe that history is going to repeat itself. So at the end, history does repeat itself. Okay, and you can see a pattern in the evolution of prices. Okay, totally the opposite of what we say for the efficient market approach, the random walk approach. Okay, that we saw at the beginning. This here, probably not the best combination of colors. Okay, but these here are some of the many techniques. Okay, the many techniques that are under this technical approach denomination. Okay, there are many. All right, I want to explain you two. Okay, one that I use and it's kind of okay, and one that's crazy. Okay, so let's go for the one that I use. The support and resistance, as known as the floors and ceilings techniques. Okay, so take that this is the graph for a price. Okay, for any products. You know how prices move in the stock market. Not so they go like this, so they go something like this. All right. So these techniques, basically, to apply it, you have to take graphs like this. Okay. When I studied, when the guy that explained us this, okay, he was kind of a big deal. Okay, he was back then. He was the director of Banco Santander, the investing side of Banco Santander for Andalusia, the Canary Islands. I know that now he is the director of Banco Santander the investing side of Banco Santander in Italy. Okay, so it's kind of a big deal. So when he explained that, he was like, okay, you had to print out a graph and then use a ruler to throw lines. Well, now you can use computers. Okay, we have evolved. Okay, that was a while ago. Okay, but then you have to take graphs. Okay, and start throwing lines. What kind of lines? You try to connect. It should be aligned. Okay, you try to connect moments when the price is gonna bounce back down, and that is gonna be a ceiling, a resistance, and you try to connect points where the price bounce back up, and that's going to be what we call the support, the floor. Okay, what is this technique saying? Is that the more times it bounces back up or back down, the stronger is going to be the support, the stronger is going to be the resistance. Okay, so we can predict that. For example, imagine that we are, let me change the color. Imagine that we are here. Okay, we are in this day. Okay, and we want to buy this stock. And we are here, and we have detected this floor that comes from longer. Okay, we can say, okay, instead of buying here, maybe at 5, I'm gonna wait until it reaches the floor again. So I'm gonna buy at 4. And then you wait, and if you are right, then you wait here it's 4, and then you buy it. You are saving $1 per stock. That can be a big deal if you are buying a lot of stocks. Okay, and then you see how the price is gonna bounce back up. Does it make sense? No, not really. It's not basic information or anything. Okay, but it makes sense in the moment that everyone is waiting to do the same thing. If everyone here is waiting for the price to drop until 4, it's gonna end up dropping because no one is buying. And if once we reach this floor, everyone start buying, we are going to push the price back up. So that's when it makes sense. And for incredible that it sounds, okay, I have seen it works. And for this, really short-term decisions of trying to save $1 per stock, something like that, €1, or buying here, or waiting a couple of minutes to sell because you know that you're gonna maybe reach the ceiling or whatever, I ain't seen it works. Okay, what happened when the price breaks the ceiling, for example? If the breaking is with an important level of demand, okay, of movement, okay, then we can assume that maybe this ceiling is going to become a new support. If the level of demand here, the level of volume, okay, is high enough. If the volume of demand, if the volume of trade is not that big, maybe we can assume that this is gonna go back. Okay, it won't break the glass. Okay, in a particular case. A little bit crazy, okay, and this application that also combine this with the volume of trading, with these bars that here that show the volume of trading, okay, so it's really interesting, okay, but for crazy that it sounds, it kind of works. That's the one that kind of is not that crazy. Let me show you one that is kind of crazy. I guess you know, you have heard about the Fibonacci sequence. Maybe you have heard, you watched the movie The Da Vinci Code, okay? When I started teaching, it was more about reading the book. I guess now maybe you have watched that movie, okay? Da Vinci Code, Tom Hanks, okay? It's kind of a fun movie to watch, okay? So the Fibonacci sequence, okay? The Fibonacci sequence, I know you know what it is, okay? You have heard about it, I guess, okay? It's a sequence of numbers that every number is the addition of the two numbers before, okay? So 3 is 2 plus 1, 5 is 3 plus 2, 8 is 5 plus 3, 13 is 8 plus 5, and goes so on, so on, so on. So the Fibonacci sequence, it has some special properties, okay? And one of them is that it reaches a point where if you divide one number with the one before, you always obtain the same proportion, okay? The 1.6181818181 or the 0.618181 if you do the opposite, okay? And that proportion is what people call or say is called the golden ratio, the divine proportion, the aurea proportion, okay? Because this is a proportion that rule over many things that we see around us in the world, okay? That golden ratio divine proportion, you can Google that, okay, and there's a lot of information on that, okay. You can see how the divine proportion is going to explain why we see something, we look into a building, okay, and we say, okay, that's pretty, or that's symmetric, okay, or that we look into even a face and we say, okay, that person is pretty, okay, that's symmetric, okay, that works. Don't trust me? Okay, let's see some example of where the divine proportion, the golden ratio, actually works. For example, some fun thing to do. If you divide the female bees by the male bees in any given hive, you will get the divine proportion. Sunflowers, we have opposing spiral seeds, have the divine proportion between the diameters of each rotation. Now, for you to do during this quarantine, okay, you can have some fun here. From your shoulder to your fingertips, and then divide this number by the length from your elbow to your fingertips, you should get the divine proportion. Okay, from your head to your feet, and divide that by the length from your belly button to your feet, you should get the divine proportion. There is even an app. Okay, there is even an app. I just discovered it a couple of days ago. It's called yeah, let me find it. It's called Golden Radio Face App. Okay, it's available for Android, both Android and iOS. Okay, in iPhones. Okay, and you take a picture of yourself, and they use the divine proportion to tell you if you are good looking or not. Yes, you're wondering. I have used it. Okay, 8.5 out of 10. It says I'm pretty, so I'm gonna take it. Okay, so who am I to deny the divine proportion that rule us all? Okay. If you don't have the divine proportion, you do this number, you don't have it, don't worry. Remember, beauty is inside. Okay, and we still love you. Okay, so that shouldn't be a problem. All right. Credit cards, sheet of papers, cars, why they are the way they are. Okay, well the proportions here is ruled by the divine proportion. Okay. Finance, people use it for finance, but it's even more Think about the ellipses that planets do around a star. That is explained through the divine proportion. Okay, so it's crazy like that. So how is that in finance? Okay, let's use it here. Okay, you don't need to do anything else. Let's clean this up a little bit, so I can draw here a little bit to explain you how that works. Okay. All right. Okay. So imagine that we have here a graph. Okay. So what it says is that graphs prices move somehow like this. Okay. Let me write here. You will see. So for people that follow this, they say that prices move following this rhythm. Okay. They do 3 big waves. Sorry, 3 small waves. One here, here, one here, one here, and 2 big waves. Okay, and the difference between the third small wave and the first big wave is, as you can imagine, explained through the divine proportion. Okay, so you can predict when to invest. If you look into Google and you go and try to find divine proportion and finance, you will see examples of that. Okay, but you know it's easy to find stuff in the past. Okay, the crazy thing here would be to try to find this out in the future. All right, I mean I wouldn't do it, but this is how crazy it gets in the world of finance. Okay, this is how crazy it gets. But you know, reality at the end of the day is that forecasting is difficult. Okay, as I told you, if it were easy, everyone will be making money. All right, so and that's not happening. All right, it's hard to be the randomness. Okay, it's really hard to be the randomness. Okay, probably the only thing that is 100% true is this sentence that the founder, you know, the Forbes magazine, right? The one that shows the list of the the richest people in the world or whatever. Okay, he said once, you can make more money selling financial advice than actually following your own financial advice. That's probably the only thing that is true. Okay, if you remember the Wolf of Wall Street, if you remember the movie, okay, they, at least at the beginning, they don't make money doing great investments, because they are actually dealing in this really residual side of the stock market. They are not making money out of the investment that they do. They are making money out of the fees that they charge for the transaction that they do for others. Okay, so they are basically selling advice or doing transaction for others, but they are not making money because they are doing great investments. Okay, so that will be the end of chapter 4. Okay, but before you leave, okay, before you leave and go to do something else in this fun time that we are living, okay, please go to Canvas and make a comment on this session. Okay, this will count as if it was assistance or class participation. Okay, so I ask you a few questions. Okay, so you want to make some comments on Percent Parity. I ask questions like if you knew Percent Parity before, if you knew something about these techniques that I'm talking about before, you have some experience, if you know about other applications of the Percent Parity, if you have a IKEA's Billy bookcase in your house. Okay, so just take a couple of minutes, okay, to say hi and make some comments about the session. Okay, all right. So I hope you guys are doing good. Okay, I will see you for the next final session on theory on finance. Bye guys, thank you.